a lot of people over the last 3 years have even had conversations about whether these factor-based funds should replace active investing because of the cost advantage and because of the way that they've performed. What would you say as things stand right now?
Look, I think honestly, any kind of passive investment, whether be factor based or a plain vanilla passive investment, has to be given due time, right? Because you are finally betting on a broader index to outperform, and for that to happen, you need a longish time frame, Alex. It's very easy in a 3 month, 6 month, even in a 1 year, 2 year kind of a time frame for any active fund or any active manager to go out and beat the index, but it becomes extremely tough if you extend the timeline. The more you extend the timeline, the tougher it gets to beat the averages, and that's a fundamental statistical law, right? So having said which, yes, it's a fact that for last 6 months to 1 year, factor based funds and all the factors, barring maybe a low volatility for that reason, all the factors have been typical underperformers and quite underwhelming, and the taste to investors has not been great. Right. So, and we can debate on factor to factor as to what's led to that kind of a thing. But yes, it's a fact that for last 1 year, none of the factor-based strategies have done well as compared to the broader index or even as compared to active styles of management.
Why is that though? Because I look at momentum, and this factor over the last 1 year has been down 19.5%. And is it that in a period of consolidation, you have a factor that depends on that momentum upside tends to lag and underperform?
Okay, so look, I think yes. Again, momentum has been the worst performer in the entire factor spectrum, down almost 19 odd percent. Having said which, if you were to look at the momentum factor from a long term perspective, let's say from a 5 year or a 10 year perspective, the returns are outstanding. The 5 year return is around 21 odd percent CAGR, and the long term 20 year return is also, if I'm reading well, around 17.5% CAGR, which is well above the Nifty averages, right? Again, as I said, in a short term, these factors can take a good amount of beating, momentum especially, because it kind of builds up on the price momentum of a stock. Stocks which are running, the whole thesis is stocks which are running will continue to run and run higher and faster. And if anything has taken a beating in last year's Indian market is the momentum piece in the market, because there's been no momentum. The market has been pretty much sideways, has correcting in a time bound manner. There has not been a very significant value correction, but any and every stock which was a price driven action stock has taken a good amount of beating, and that's where I think momentum as a parameter has got the maximum amount of it. But my sense of this parameter, Alex, is that once the market comes back into a frantic cycle, which is a frantic up move cycle, which always keeps happening with the market every 2 years, every 3 years, or whenever that happens, I think this is one parameter which will again bounce back the fastest. So one has to be really patient. Again, as I repeat, this is a pretty long term money. It can't be judged on a 6 month to a 1 year parameter.